ended up getting questions. We're obviously not going to do questions.
Okay.
That's a different session.
Yeah, I'm gonna give them my phone number and my email address as well. Like, I'm pretty sure that if people just want to rage, I'm, I
Yeah,
get
we are open that people are coming in, just so you know. So,
okay.
okay, good.
Mhm.
Yeah, we got the doors open. So, oh, that's good. Jim and Cameron switched to, oh, when Tony went away. That's what happened. Okay. All right, good. Good, good, good. So we're getting everybody in. So we got a lot of attendees today. So it's really exciting. And I'm excited to have Kate. By the way, thank you very much for making the time. So we do
No
appreciate
problem. Happy to
appreciate
help.
you a ton. So especially since everybody's off on the president's retreat. What is that
Yeah,
anyway?
yeah. It's like the PAC, the Political Action Committee. So if you have paid a certain amount of money, you get to attend this event, and they have it in places, and they have big speakers about advocacy and whatnot. So they're all down there a lot, but I think it's I don't know that there's a whole lot of attendance this year. I think attendance has gone down quite a bit, but
Is it Springfield when you say down there?
no, they're in Miami right
Oh,
now. Yeah. So it's NAR President Circle.
oh, okay. Oh, I'm
Mhm.
sure. I'm sure that's entertaining. With that's a hell of a place to be, all things considered.
Sure. We were at the Association Executives Institute when all of this kind of hit. And we were all like, so we were all kind of in the same room as association executives, learning with the settlement as everything was happening. So
Ah.
it's been a whirlwind of a weekend, that's for
So,
sure.
so Mr. Heisler is actually attending online. So he's actually
Oh,
said
good.
he said there's 1,200 attendees in Miami right now.
Yeah, yeah.
So he was
Mhm.
interested in what he's interested. No pressure, but Jim Heisler came to hear what Kate has to say. So, all right. So we'll get things rolling. It's around 12 o'clock. I wanted to thank you guys for making it here. One of the things that is really important to us here is making sure we bring a lot of education to our agents. And obviously, with the settlement over the weekend, we had reached out to a few people with the boards because honestly, I think there's a lot of really bad information about what's going on out there. And I honestly think as agents, you should rely on your boards for the correct information as far as at least what we know today. So we really limited our reach out to Main Street and Jim Heisler's with the Heartland board. So we were very blessed enough to have Kate Sachs make some time for us today. And what we have, just because we do have a full program for everybody as well, Kate's going to basically just talk a little bit about the lawsuit. I know when we had other people sign in after we had Kate announced that Kate was coming, people listed questions, but we're really not going to do any Q&A. Kate is going to give you guys some ways to reach out to her afterwards. So before I get into our host and before I get into our guest speaker, I want to start with Kate Sachs from the Main Street Board of Realtors and her comments about the NAR settlement.
Well, thank you. I appreciate it. And good afternoon. Thanks for allowing me to join you this afternoon. And as many of you are aware, the National Association of Realtors announced that they have entered into a settlement related to the class action litigation on behalf of some home sellers related to broker compensation. So the settlement resolves claims against NAR. It's 1 million members, realtor associations, all association-owned MLSs, and some brokerages with a residential transaction volume of 2 billion, or from 2022 of 2 billion and below. The settlement also provides and allows for a mechanism for MLSs such as MRED, which are not owned by realtor associations, to opt into MLS practice changes. MRED will make their own independent decision as to whether or not they will opt into that settlement and therefore agree to those terms. So those terms were to include a prohibition of listing cooperative compensation or cooperative offers of compensation in the multiple listing service. Additionally, NAR agreed that MLS participants will, when they're working with buyers, they will enter into written representations agreements with those buyers. So while these changes go into effect mid-July. There are still some unknown pieces, like Enmerd's decision. So this settlement must be approved by a judge, and we are going to be closely monitoring, as other local associations of realtors will, on what is happening locally and how that will impact our members on, I'm sorry, what will happen nationally and how that will impact us on a local level. And that said, I'll say I'll give Main Street a little bit of a plug here. We've not shied away from this conversation in the past year. We have created many resources to help you understand the context of these lawsuits, the outcomes, as well as updated forms and contracts to ensure transparent conversations about agency compensation with both buyers and sellers. And we believe that our members stand out as the most educated on these issues. And we want to see that continue in further with education on these particular topics. I would encourage you to visit Main Street's website, which is succeedwithmore.com/compensation, or NAR's website, which is facts.realtor, for further information related to these issues and more. Videos, resources, those types of things to talk you through how to handle these conversations and really placing yourself in the middle as the expert, as the realtor expert of all of this, right? I will say that as this situation evolves, we will ensure that our members are kept up to date and informed on these matters. But I will say, on a personal note, I would never in my life, I know a lot about real estate. This has been my only job here. I've been at Main Street. This is my 21st year in this, here. I know a lot about real estate, and I would never, ever purchase a home without a realtor. And I think that those types of things, I want you to know that we're here for you. That if you need a moment to rage because you don't understand or agree with the settlement or the way that things are being handled, give us a call. I think that there is a lot of media reports on this that are incredibly frustrating, and sometimes they're just simply not accurate. So if you are, I know that NAR did put out a statement today on some of those issues related to how and what is being portrayed in the media. So if you're interested, I am certainly happy to send you that link. And if you are, I would exercise, as a Main Street employee, I am paid to reduce your risk. And so therefore, if I can give you one bit of advice, if you are prone to posting on social media related to this particular matter, I would encourage an abundance of caution. There is a lot that is being said right now, a lot of information that is out there, and a lot of misinformation, a lot of people talking about things that they do in their own state versus what might be legal here in Illinois, and vice versa. So a lot of the information out there, try to use caution, know what you know from a license law standpoint, from a code of ethics standpoint, and we'll take this one step at a time. But I can be reached at kate@succeedwithmore.com, or my direct line is 630-324-8425. So I'm happy to be there for you. I'm happy to answer any questions that you might have offline, and we can kind of work through these issues together. But there's more to come. It's not over yet. So just take a deep breath. And like I said, if you need to rage, I'm here for you. Right.
Kate, if you
Thank you,
would,
everyone.
I know Tony's, if you don't mind, can you put your contact information in
Oh
the
yeah,
chat?
absolutely.
And then I know you had a couple links either for NAR and or Main Street where
Mhm.
people can go and get more information as far as that's
Absolutely.
concerned. And I know, what Kate talks about on the social media, we've actually seen vendors, I've seen attorneys, real estate attorneys already putting some things out that didn't really make a lot of sense. So, I mean, I would definitely advise everybody to be very guarded in what you present in social media. Obviously, I think the media's interpretation, if you go from Good Morning America or the New York Times, or even an article that would came in our office yesterday from CNN, there's just so much bad information out there from things like, well, this is going to be cheaper for buyers. And I don't know in what world this becomes cheaper for buyers. And then the fact that, of course, sellers are going to drop their asking price, which is certainly going to help because they don't have to pay the 2.5%. Give me a break. Neither of those things are realistic. So there's
And I
just
think
so
it's
much.
really right. It's important, right? Because there is no standard commission. There is never been. In fact, there's ample documentation to indicate that that has never been the case. So a lot of these news reports saying that they're reducing standard compensation is just simply not accurate. So that's, I think, the main issue for me right now is trying to deal with that whole situation there, but also to encourage people to understand that there is nothing ever that has been set by the National Association of Realtors in relation to a standard compensation rate, nor is there a current standard anywhere in Illinois or within any local association of realtors or MLS.
Yeah. Yeah, that's Jim Heisler put in the chat if you guys have access to it. Jim is hopefully I say this right, the director for the Heartland board.
He's the CEO.
And
Yep.
yeah, so thank you. And so he's also commented in there, so things you guys should read. Kate, I want to thank you very much for coming. You guys have access in the chat. Obviously, it's a developing story, but we wanted to get you at least as much information as we could. But we do have to get into our credit stuff, which I'm super excited, guys, because I've got over 30 questions from you about credit. And so one person that you should also never enter into a transaction with is a lawyer. So I wanted to thank certainly Popovic Law for taking care of your lunch out there and mine. And without further ado, Casey, do you want to tell us a little bit about Popovic Law? Kate, thank you very much.
Appreciate it. Bye-bye.
You got
Thanks,
it.
Rich. Thanks, Rich. Thanks, Kate. Really appreciate it. Yeah, to echo kind of sort of those comments, the first thing I saw on my phone this morning was an article about the NAR suit. And there was just a lot of information that, like I said, like Jim said, there's more questions than answers right now. So I would definitely echo that sentiment. But a little bit about me. I'm with Popovich Law. I'm one of the associate attorneys. Some of you may know the managing partner here. Her name is Libby. You may have worked with her before. I've got myself, Cameron, and then this is Matthew Searles. He's another associate attorney. So we work primarily in real estate and then also estate planning. So your residential buy sales, your commercial buy sales, lease reviews, commercial lease reviews and negotiations. And then, also working on the side with landlords in terms of sending out notices to tenants, stuff like that. So we're a full service firm along with our paralegal, Teresa. We do offer, in addition to just these services, we do offer free lunch and learns. We'll come to your office, bring lunch. We'll do a workshop, some of the things we've presented on before, foreclosures, what that means, when you have a seller in the market. Estate planning, kind of getting you familiarized with the different estate documents. If someone's approaching you with a listing, let's say there's a trust on it, the property is in probate, it's not in probate, what, if there's a deceased person on title, what that means. So we've really, run the gamut with that. We do offer free first-time homebuyer workshops as well, which I know we've done a couple with Rich, in the past. So we offer all of those. Libby is also a licensed real estate instructor, so we kind of cover the board. We offer free consultations if you have any questions on anything, whether that's estate planning, real estate matters, stuff like that. We got multiple offices. I'm here in our LaGrange office right now. We also have Tinley Park, and we go all over Will, Cook, DuPage, Lake, all those counties. So we're full service. And we're here to help with anything. And I hope you guys enjoy lunch.
Thanks, Cameron. I know Popovic's great. I'm always happy to see when they're part of the contract because I know I'm going to get good counsel, especially when you guys represent the seller side, because I know my poor processors aren't going to have to beg to get title in a timely manner. So you guys do a good job. Seriously. All right.
Thanks,
no problem. Thank you very much again. So we got Jim Drusky on here. Jim has not only been ultimately probably one of the greatest resources we have on all things credit. Jim has been at this credit piece for, I want to say 16 years. Am I right? 16, 17 years, Jim?
15 with Illinois Credit Services, yes.
15 with Illinois Credit Services. Now, one of the things I really love about Jim is he used to do what I did. So he understands what we need to get your clients squared away so we can get them financing. B, he's local. So he's right here. Office is still in Plainfield, correct?
Yes.
Perfect. So he's local,
Mhm.
and he's also an expert witness in trials on all things credit. So, without further ado, I know Jim wants to talk to something, just give you guys a brief overview in credit. And then I'm going to get into your questions. We got some phenomenal questions. Ray Kennedy, by the way, also added a question as it related to, where'd that one go? Oh, there it is. As it related to some things on the lawsuit and seller credits. We're going to talk about that too. I made a note in here to talk about seller credits, but without further ado, Jim Drusky, the floor is yours.
Thanks, Rich. It's always good to be here and talk credit, and this is always the fun part, right? So, there are a bunch of questions. There's a lot of really, really good ones, but I wanted to give a little bit of background about how scoring works and a little bit about me too, and some of the misconceptions. And that's all going to kind of make sense as we go through some of these questions. So, as Rich mentioned, I own a mortgage company. I understand the mortgage process, and I've been in credit related industries for 32 years now, actually. I've been teaching classes on credit and credit scoring at the College of DuPage for 9 years. I do a bunch of expert witness work and in federal court. And the thing that was touched on earlier about misinformation on social media and things, I mean, I think the credit industry invented misinformation, really, because there's so much bad information out there of all the gurus on Facebook and TikTok talking about all these empty promises and these hacks, and their cousin works at TransUnion and blah, blah, blah. And, so the questions that we're going to cover today, and if you have more, I think we can put them in the chat, and hopefully we'll be able to get to all of them. So I don't want to spend a lot of time on this part of it, but I do want to set the concept of understanding what a credit score is. It's what a credit score is not. It is not a grade of what you've done in the past. That's what it seems like, because you have your report, you have all this information, then you have a score. It's kind of like, it seems like a test grade, and it is actually not that. A credit score is not a grade of what you've done in the past. A credit score is a prediction of what you're going to do in the future. It has nothing to do with the fact that you were late 3 months ago. It's the fact that if you were late, that indicates that you might have another delinquency happen again in the future. And that's how credit scores were designed. They were designed for lenders to utilize that information to figure out, hey, do I want to lend you money? So a lender is trying to figure out, if I lend you money, what's the chances of you going delinquent in the future? So scores are predictive. They're not a test grade. It's more about the future. And some of that's going to make more sense as we go through some of these questions. And when it comes to the big concept of repairing credit, we're going to cover a lot of things of, proactive things that you can advise your clients to do, and talk about as far as things that doesn't have anything necessarily to do with derogatory information. But when it comes to accuracy and derogatory information, that's where it comes down to, there's nothing magical or mysterious about it. It comes down to the laws. There's the Fair Credit Reporting Act. It's 108 pages of information, of laws, basically, that protect the consumer. There's procedures that these companies have to follow. And what's very difficult for a consumer to navigate through is, if you don't know the rules, how are you supposed to play the game? If you don't know how they're supposed to respond or what they're supposed to do or not do, you really don't know how to hold them accountable to that process. So I just wanted to give you a little bit of that background, and we're going to kind of dive in question by question and kind of cover as many of these as we can, if not all of them, correct?
Yeah, we're definitely going to get to these. We got some awesome questions, Jim.
Let's do it.
All right, perfect. This one came up about two or three different times. So, and I'm just going to quote one person in here. So, as an agent, and this is intriguing, how can I best help my clients improve their credit scores? So I kind of like that. It came at us three different ways.
Yeah.
So I figured I got to hit you up with that, but it's a unique one.
Yeah, well, fair question based on, the goal and what everyone that's we're trying to do, right? Trying to help people improve their credit scores. And it's not a simple answer. I mean, there's two words that apply to most answers to questions, and that is it depends. It depends on what's on the credit report, right? So the simple thing that you want to do is look at balances on credit cards. First of all, make sure somebody has a credit card. They have to have a credit card to have good credit. That's the first thing. They can't misuse that credit card. So the first thing that you want to do as an agent is talk to them about their balances on their credit cards. That can be a really simple question and answer of, hey, pay down your balance, but in many ways it gets more complicated than that because it's usually more than just the balances on credit cards that are affecting the scores. If there's derogatory information and things like that, those are things that really we need to dive into a little different topic. It's not so easy to fix that necessarily without professional help. So first thing is always the balances.
Yeah, and I would say as an agent, I think the best way to get your clients help with their credit, get them to a mortgage professional that can pull the mortgage credit reports
Mhm.
and then start giving them advice. And honestly, sometimes the advice is for me to hand them off to Jim
Yeah.
because they really need some more accelerated. It's not just a one or two thing. It's not something where I could say, hey, just do this one thing and you'll be fine. So we
And
can't.
sometimes it is that though. Sometimes it can be, right? And it's not always so obvious but it really takes understanding some of the scoring models and the algorithms too. And and I think we're going to cover this in some questions, but when it comes to the scores, you got to have the mortgage scores, right? So the first step, I guess, would really be other than
Well,
balances like that.
let me segue that. Sorry,
Yeah.
Jimmy. Let me segue that into Joni's question. So
Sure.
she said most people pull their credit scores from their credit card statements. However, mortgage loans use a different FICO system. When people give you their approximate credit scores, what should a realtor add or subtract? Let's say the client goes up to Joni or any of our agents here. Hey, Joni, just check Credit Karma. My credit score was 700. What is that? Can you translate that into a mortgage score? And if not, why?
Translate that with a grain of salt because you want to use it as a directional score only. There is no mathematical formula that says if your credit card score is this, your mortgage score is going to be that. Because remember what I was explaining, that scores are predicting future delinquency. All the industries, mortgages, credit cards, auto loans, they all have industry specific scores predicting the likelihood that you're going to go late on a mortgage within the next 2 years. There's credit card scoring models. When they see their credit card statement, generally they're getting a credit card FICO score. And that's a different scoring model predicting the likelihood of going late on a credit card. They can be very, very different. And same thing with an auto loan score. I mean, I had somebody yesterday that there was one scoring model that was a 590 and their mortgage score was a 682. So it's not always, a lot of times the mortgage scores are less. That is true, but it's not always less. It depends on the content of what's in that credit report. So regardless, there's no mathematical formula of subtract or add this much to any different scoring model that you see. And that's the problem with credit in general. Consumers are seeing their credit scores all over the place. Credit card statements, Credit Karma, Credit Sesame, whatever. They throw these numbers at people and they think, oh, I can get a mortgage. I'm a 639, but then Rich may pull it and it might be lower, maybe higher, who knows? But the important thing is to get the mortgage scores.
So we had a question come in on the Q&A side, and it's Michael asked, does Illinois Credit Service help establish business credit?
I know a lot about it. We used to do that actually. And I have a lot of information I just give for free to clients that we're working with on their personal credit that I just help them do that. But the problem is when you pay somebody for establishing business credit, the business owner is really doing a lot of the legwork. So I just share the information for free with people to help them do
Nice. No, that's awesome. Let's go into another question that we have here. So Juan asked, what do you tell clients the advantages of using a credit specialist for credit repair versus doing it on their own? So why use you versus doing it on your own is basically Juan's question.
Well, it's a matter of understanding how the process works. Here, if you're going to play baseball, do you want Babe Ruth in the batter's box, or you just want to walk up and swing at a pitch yourself? It's the problem is that the credit bureaus and a lot of these big banks, they encourage people to dispute electronically. Electronically is not the way to dispute things on your credit report. They're not trying to do you any favors. What they're trying to do is lessen the cost for them to process the disputes. And what people don't realize is when you do that, you're requesting an expedited dispute, and you're giving up 3 paragraphs of your rights under the Fair Credit Reporting Act, where they can actually just put it right back on your credit report the following month.
Ooh, yeah.
Yeah, and that's where everybody says, oh, credit repair doesn't work because it gets deleted and then it just gets put back on. That's because on an expedited dispute process, like electronic disputing, they can delete it immediately and then put it right back on without following what's called reinsertion procedures. If you do it by mail and writing letters, they cannot do that. And again, what it really comes down to is understanding the laws, understanding the process. If you just want to take a shot at it, you're just kind of, it's not really the way to do it, especially don't do it online. I mean, it's kind of like if you were going into court, you would never, representing yourself, you would never go up to the other side's attorney and say, hey, what kind of questions can I ask here today? Because that's essentially what they're doing. It's kind of an adversarial you against them process. And when you dispute something online, they're telling you the questions that you're allowed to ask them, which they're only going to, they're only going to allow you to ask them the easy ones, not the hard ones.
Yeah. And you know what, the other thing that to Juan's question, the other thing that I talk about, a lot of people are not in jobs or roles where they can call somebody during the day. We have a lot of people that don't have access to a phone based on whatever their job might be. So if you can't call people during the day, I think it's another reason to employ a credit specialist to help you out. So I'm going to go to Mark's question here. How accurate is the MyFICO application for determining current credit score?
Extremely accurate. It is, yeah, the MyFICO, in fact, it is a soft pull. MyFICO is really like Credit Karma, but if it's free, it's probably worth what you're paying for it, right? So Credit Karma is okay because it's free, but it's a very tricky website designed to make millions of dollars without charging anybody anything. But MyFICO, if you want a legitimate score, if you want to know what the mortgage scores are as a soft pull, go to myfico.com. There's right now 40 different FICO models that are commercially used. MyFICO gives you, I think it's 26 of them, 25 or 26 of them, including the mortgage scores, the credit card scores, the auto loan scores. And so that's a great place to see the accurate score. So if you see the mortgage scores on MyFICO and then Rich pulls the credit reports, assuming nothing changed from the 2 times that the credit reports were pulled, they will be the exact same scores.
Okay. I'll get to Michelle's question in a second. I want to kind of work the list we got too. So, speaking of services, this is kind of a decent segue. What's the best credit card monitoring service on the market for consumers and businesses? That one comes in from Naishka. I think I said that right.
For personal and business, or just personal? What was the question?
Yeah, no problem. What's the best credit card monitoring service on the market for consumers and businesses? So I'm not sure you.
Yeah, so business is, that's kind of a different animal that's done in Bradstreet and things like that. But as far as for credit monitoring, there's a lot of choices out there to see your credit reports. Again, there's free ones. I mean, you can go to annualcreditreport.com and see your credit report if you want. That's the one that truly is free. And it's actually not annually anymore. It's weekly. After COVID, they decided to do it weekly. So here's the problem with that. When they give you something free, they'd rather sell you something, right? So it's a very bulky report. It has no scores on it. The information's okay, but be prepared to keep loading paper in your printer when you're going to print that thing out, because it is a very, you might have what a normal report would be 30 pages. You could have 100 pages for each credit bureau times 3, and it could be a 300-page report. So it's very bulky. The one that we use, and I use personally, and I've researched a lot of them, it's a link that's seemy.credit. It's SEEMY.credit. It's not .com, it's .credit. And that one is a nice, easy to read 3 bureau report that is, if you're looking at the content, it's really easily laid out. My FICO doesn't lay out the reports very easy to go through. It's good value for my FICO to see the scores, see my .credit to see the content of the reports.
Okay. And Tony will include a link in your email afterwards, guys. We always do an email afterwards. We do send a survey. Please fill out the survey for us. It's really helpful. So going back to the conversation relative to, okay, I'm going to try to do this on my own. I'm going to electronically dispute. Michelle asks, and you just mentioned, I'm going to forfeit 3 paragraphs that are protecting me. What she asked, what are those 3 paragraphs? What do I lose when I go electronically versus handwriting, or in this case, typing out, snail mail?
Yeah, the biggest one is the one that I already mentioned. It's the other 2 are less relevant, but it's the lion's share of it is about reinsertion. And that's the one that people need to be concerned with. And the other part of the problem is there's no follow-up that you're allowed to do. There's no, they don't, when it's kind of a back and forth chess game, if you dispute something and they respond, what do you do from there? There's not a follow-up. When you're writing letters, you can do follow-up. You can say different things, use different laws. And that's where, honestly, when something's disputed, there's procedures that these companies have to follow. If you look at the credit report and you can see that they didn't put certain comments on the credit report, then you can call them out on that, because that's a violation of the Fair Credit Reporting Act and potentially a reason that account could be deleted from the credit report. If you're doing it electronically, you don't have that ability to use the law in your favor. You're basically doing it on their terms, not your terms.
Nice. I like that. Okay, let's see here. So there was a comment that came up about the word trigger lead, and I don't even know if everybody here knows what a trigger lead is. So I'm going to take a minute here and talk about this a little bit, because they are impacting your mortgage clients or your home buyers for sure. So what happens is, this is a conversation we have every day with every consumer we talk about or talk to. And ultimately it's this: Experian, TransUnion, Equifax, those companies actually are data aggregators. So their job really is to collect and sell information. It just so happens one of the things that they collect is people's credit, and they sell that back to mortgage companies. But there's other ways for them to make money based on credit. One of the biggest things they can do is sell what's called a trigger lead. So what's a trigger lead? If I create a hard inquiry on one of your referrals to me, and that then instantly goes, that Experian, Equifax, TransUnion, instantly, now when I say instantly sells that, the fact that I pulled credit, to a marketing company who instantly sells it to mortgage company boiler rooms. And unfortunately, your client's cell phone is really inoperable for the next 24 to 48 hours. We've had stories where clients are getting over 100 phone calls from various mortgage boiler rooms, telemarketing firms, and whatnot. Now, we have a process that we do to kind of avoid that. And one thing about trigger leads, it's become so bad that there is 2 pieces of legislation sitting in DC that's actually written to outlaw or ban these trigger leads because of the really harassment. If you're getting 100 phone calls a day, that's harassment. I'm sorry. So the problem with those 2 pieces of legislation is they were written in April of 2023. So, nothing's really happened there. So we, as a mortgage company, will, if we can, do a soft inquiry, and the soft inquiry doesn't create that avalanche of phone calls. In the interim, we'll ask your clients permission to go to optoutprescreen.com, and Tony will throw that in the notes, but it's OPTOUT, then the word pre-screen. With your client's permission, we will opt them out so their information cannot be sold by the bureaus to the marketing companies and to the mortgage companies. Now, that's trigger leads and what they're all about. Now, one other thing that you may or may not know is the credit reporting companies are preparing for the fact that they're about to lose all this revenue. So what they've done for our credit reports that we order for your home buyers is they've increased those fees by up to 400%. And it is something right now that the Consumer Financial Protection Bureau is looking at, because we've basically went to everybody and said, this is ridiculous. Nothing's changed about what we're asking the credit reporting agencies for. We're hitting a button. They're sending us the data. Is it worth a 400% increase? No, but it is, because they're about to lose this huge chunk of revenue from selling leads.
And you know what, Rich, real quick, the credit bureaus are blaming that price increase on FICO, because the FICO changed their fee on mortgage reports from $4 to $8, but the overall cost went like up to whatever it was, significantly, way more than $4.
A joint mortgage credit report is $250. That's
Right.
insane.
Yeah.
I mean, that's insane. And we as a lender have no choice but to pass that on. But that's insane.
Right.
So, okay. So Rick's question is, does my FICO sell trigger leads? I'm not really sure what you'd be triggering by going to my FICO, but isn't that a soft pull anyway?
Yeah, yes, they're a soft pull, but in the bureau, to my knowledge, the bureaus have the data. My FICO doesn't really have the data. My FICO is a reseller of the 3 credit reports, just like anything else. And actually, if you go to Experian.com and order the 3 credit reports, you can order your Experian report from Experian. But if you order TransUnion and Equifax from Experian.com, they are a reseller, just like my FICO's a reseller. They're a reseller, just like Credit Karma is. They all resell each other's data.
All right. I got 3 or 4 questions that are awesome here. I want to make sure we get to these. So Maria asks, what is the fastest way to build good credit for people who recently moved to the United States?
Yeah, so now when it comes to FICO scores, there's a minimum score requirement, minimum data requirement to generate a score. Remember, scores are trying to predict something about you in the future, right? That means that the scoring model has to see enough information about the person before they can score it. So FICO scores require that you have to meet 2 criteria. You have to have at least 1 account be 6 months old, and you have to have 1 account reported within the last 6 months. So there's basically, if somebody just comes from another country, there's 2 ways to do it. You get a credit card. It's probably going to be a secured card. If they have nothing else on their credit, and then they're going to wait for 6 monthly cycles, and then they'll generate a FICO score based on that information. The other way is to be added as an authorized user account to someone's credit card. Be careful. Do not, when I say this, I'm talking about a relative, a family member, a close personal friend. I am not talking about these internet websites that sell and rent the trade line data. You can go out there and pay $800 and get added to a really good credit card. It's fraud though, because you're saying you're an authorized user when in reality you're not. So be careful with that. Stay away from those. Do it the right way. What I recommend is basically 3 things. If you can be added as an authorized user and get your own credit card. And the third one is, in that case, do Experian Boost. If you haven't heard about Boost, it's the only time I don't think Boost is a good idea, because when you see the commercials about, I'm going to boost my scores so I can get my mortgage, right? Because the problem is the mortgage scoring models do not recognize the data that Experian puts on the report. They don't recognize utility data. So it might boost your Credit Karma score or one of the other scoring models, but it will have absolutely no effect whatsoever on your mortgage FICO score. Now, The reason why it could be good is if you have and Rich, you might be able to talk to this more. If you have a thin credit profile and you have one $300 credit card and an authorized user account, Experian Boost can add some non-traditional trade lines to boost up the credit file a little bit. So, which could be
Okay.
good in that scenario.
Yeah, it could be good certainly for other things. Yeah, we're a
Yep.
little bit behind. We don't have time to talk about why the
Yep.
industry hasn't upgraded their FICO scoring models. But
Yeah.
Michelle asks, and this is a great segue here, is being an authorized user considered less than having your own strong profile? And which retail accounts really matter? And I think she's talking about like department stores and things like that. But the first part of the question is, hey, if my whole bureau is authorized users versus I got my own stuff, is there a difference?
Yeah, for scoring purposes, no.
Okay.
The scoring model either acknowledges authorized user accounts, or sometimes a scoring model does not count authorized user accounts. In the more we're talking mortgages, right? Mortgages, it's
Right.
not going to make a difference. What could make a difference is if an underwriter sees 4 authorized user accounts and none of your own credit, they're going to say, well, then none of this is yours. I don't care that your score is a 780. It's not your credit. So that could complicate things. But from a scoring perspective only, it makes no difference whether it's authorized user or not. Store cards. There's no difference between Visa, MasterCard, bank cards, and department store cards. However, I tell everybody just stay away from the store cards, because if you have the problem with store cards is those are generally when you have 15 cards in your wallet, right? Because if you have a Macy's card, you have to have a Kohl's card. If you have a Kohl's card, you have to have a Target card, and you collect all these cards, and more is not necessarily better. You don't need that many cards. It starts to impact you adversely a little bit because you have too much credit going on, and you don't need to have balances on all of them. And it gets, and you tend to have lower limits on those store cards too. Get the highest limits you can on your Visas, MasterCards, Discover, and American Express, and call it a day.
Yeah, I get, and Michael, I'll get to your question, but I wanted to talk to Claudia's, tackle Claudia's because I think it's really good. So on Claudia's, how old do you have to be added to a credit card for an authorized user? Jim, you don't have any experience with that, do you?
No, but my 21-year-old daughter does. She will tell you that she was added when she was 12. Actually, she doesn't even know that, but yeah, I did it when my daughters were 12 and 16. Here's the thing. The reason you can be added when you're that young is you have no obligation to pay for an authorized user account. You're just authorized to use the card. Anybody will let you go in and use a credit card. You have no obligation to pay that debt. That's why you don't have to be 18 to do that. And here, when my daughter was 12, she had all that history. But the problem is you can't really pull the credit until you're 18 anyway, but that's okay. You're building up that credit. So when on their 18th birthday and you run their credit reports, they're probably going to be over 800 credit scores. So sooner the better, 10, 12, doesn't really matter. Do it early.
Claudia, get that young man at home. I know who you're talking about. Get him added to your card. Don't tell him though. All right, Michael has a question regarding does Experian Boost is there a pull on your credit? And what he's talking about in inquiry, and I got some follow-ups on the inquiry, but when you go to Experian Boost, does it create an inquiry on your card?
No.
Sorry.
No, what you're doing, and you mentioned earlier about that they're data aggregators, right? They sell information. The ones with the most information to sell is winning the game, sort of, right? They're not doing Experian Boost out of the goodness of their hearts. It's a business model. They do it for free, but what you're doing is you're giving them access to all the information in your checking account. And then they're going to take a couple accounts, your cell phone bill, your gas bill, or whatever, your utilities, and put it on your credit report as a trade-off. Sometimes that's beneficial. Generally, if you're going for a mortgage, it's not going to help you at all on your score. So it's not an inquiry though, because Experian has the data already. It's their reports. They don't have to run an inquiry.
Perfect. All right. So next question is, it relates to inquiries, and I'm actually surprised that I didn't see that. I was looking through our 33 plus questions and this one didn't come up. So I'm going to ask the question and then I've got a follow-up that was in here.
Okay.
What does the average mortgage hard inquiry look like as far as a points deduction, or is there even a points deduction?
That's the answer. That was 2 words that I mentioned earlier. It depends.
It depends. There you
It
go.
depends. Depends how many you have. It depends on, again, it all is about, does it represent greater risk, right? If you have, so if you're gonna pick a number, it could be anywhere from 1 to 6, 7 points, something like that. But there's nothing there. There's no part of the algorithm that says, hey, 1 inquiry equals 4 points. It just doesn't work that way. It becomes part of all the data that the algorithm's reviewing when they're assessing risk for the overall credit profile. So if you got a really, really strong credit profile, does 1 extra inquiry indicate higher risk of you not paying your bills on time? Well, not really. But what if you got a messy credit report? You got some collections, you got some late pays, you got this, you got that, and now you're on your 4th credit inquiry for a credit card in the last 2 months. Well, every inquiry that's going to, that could be a greater impact. So it depends a little bit, but it's very
No,
small.
and I've got a couple other questions around that, but I want to jump to Nancy's question. Nancy asked, can you remove a hard inquiry from your credit report?
Anything can be removed from a credit report. There isn't anything that we haven't had removed at one point or another, whether it's an inquiry, whether it's a bankruptcy, or whatever it is. But you can't make false claims to credit bureaus either, right? So you cannot say, I didn't apply for that if you did. It's illegal to do. And there's a lot of people that get caught up in inquiries of, hey, fix my credit. I have all these inquiries. And I'm not sure if we have a question about inquiry deduplication or not, but
yeah, that's and what we're talking about there. So was one of my questions, because I don't want
okay.
to deduplication. My head just spun. But anyway, so
Yeah, right.
so if somebody applies for a mortgage, and I talk to agents about this all the time. So client comes in, says, hey, I applied at ABC lender. Realtor really wants them to use their own lender, maybe because they trust their own lender, maybe because they've had a really bad experience with ABC lender. Is there a certain amount of time that client can go to the new lender from the old lender's inquiry where the new lender's credit report doesn't have an impact?
Yeah, generally there's a window of 30 days where all the inquiries for the same type of purchase. Now, this applies for mortgages, auto loans, and student loans. It really comes into play on the auto loans and mortgages mostly, but all the inquiries dated within 30 days of each other are going to compress to count as only one, because the concept is that consumers have the right to shop for an interest rate. If it hurt you every time you compared a rate and somebody ran an inquiry and it kept dropping your score, that's harming the consumer. So the assumption is you're only buying one house, you're only buying one car. And so they combine all those inquiries and allow people to rate shop so that they aren't going to adversely impact their score. So if there's one inquiry or there's 20, it all counts as one if it's in that window.
So Nancy asks as a follow-up question, is if a client is applying to several different apartments to try to become a tenant, because they've had several different inquiries for rent, is that also considered one?
Nope. It only applies to, so again, this comes down to the algorithms as they were created in 1999, because the mortgage industry is still using those algorithms. The only compression logic that they developed was for mortgages, student loans, and auto loans. So tenants, rent screening, all those rental inquiries, if they go shopping and they have 10 different inquiries for rent, that's 10 inquiries. They're all going to count. There's no compression.
No kidding. Okay, that's interesting. So a renter who's already not got a great score is going to actually trickle down as they're applying and getting turned down, unfortunately, because of their score. That's unfortunate. All right. So Robert asks, can paying off an auto loan reduce my credit score?
Not immediately. Over time, it's possible, because there's nothing, it's not that they want to see you in debt so that they can, because that's what a lot of people think is that you have to have debt to have good credit. Not necessarily. First off, when something's paid or closed, you don't lose all that history. It stays on your credit report. What you start losing over time is the clue about how you're repaying that debt. An installment loan, like a car loan, it's a clue. You're showing that, hey, you were told to pay $475 a month every single month. Are you doing that? As you do that over time, you're providing good, solid, healthy clues to the scoring models that say, hey, you're a good risk. Look at what you keep doing over and over and over. When you pay off that loan, it's not that your scores are immediately going to drop because all that history is there, but over time, as that starts fading off into the past, if you're not having any more of those installment clues. So over time, it can start adversing. And here, I haven't had a car loan in a while. When I had my car loan, I had hit a perfect 850 credit score at one point, and now my scores can't really get above 815, 820 because I don't have an installment loan right now. But I'm not going to go out and buy a car for that, you know? So,
well, that's actually, Michael's got a great question. What's
Yeah.
the simplest way to improve my credit to 850? And I think we've already talked about it. Active installment loan, right? Active credit card. What do I have to have an 850?
Google CNBC perfect credit score. It's an article that CNBC did about my credit when I was an 850, and I actually spell it all out exactly what you need to do. And here's the other thing that's overachieving. You don't really need it. As soon as you get above 760, you're getting the best of everything that anybody has to offer. But I get it. I appreciate when people want to get to that pinnacle. Totally. There's a lot of little things that have to align perfectly to hit it, but for you, I hope you hit
it. For sure. And I agree, you know, is to kind of follow up on the mortgage side from Fannie Mae and Freddie Mac. Once you go north of 760, it's perfect. And just a quick interesting story, we had a couple come in, recently married, you know, opposites attract. So we had the 760 score who just married the 620 score. And of course, they wanted to try to go conventional with minimal down. So we made a bunch of recommendations for the 620 person to get over 700. And they came back to me 30 days later and they said, hey, we did all the things you said. We're time for us to look at the credit again. I said, great. Did so-and-so do this, and that? Well, no, so-and-so didn't do anything. And that particular person was the 620 borrower. The person with the 760 made a bunch of changes. And we're like, why? And we literally repulled the credit and they dropped their score 60 points based on doing foolish things. So, you know, it's just crazy to me. Like once you're at 760, don't change anything. So it's crazy. All right.
Hey, here, one quick side note on that. Once you're married, your credit reports do not combine in any fashion whatsoever. What you have, what they have, and it stays that way until you apply for something jointly.
Yeah, Raven's got a good question here, but I don't think you've got an answer for it. So she mentioned, like, she said car companies, you know, when you apply, I think she's talking about going out car shopping. So if you tell the car place, hey, please don't send my information to a million different banks, and they do it anyway, is there anything that you could do? You know, and yeah. Jim unfortunately has a little car history business, and
yeah, I have a lot of it actually. Yeah. And this comes down to the legal experience I have too in this stuff. Here's the thing. You can request that. You can't stop them from doing it. It's not against the law for them to do it. Because under the Fair Credit Reporting Act, when you give somebody permission when you apply for something, you're giving them permission to a permissible purpose to run your credit. There's nothing in the Fair Credit Reporting Act that gives the consumer the ability to limit that permission. You either give it or you don't. So, you know, it's bad customer service for them to do it, and they shotgun it all over the place. But the reality is it's more aggravating and frustrating to the consumer more than it is an impact to the scores. What I always tell people is that there's other bigger problems that you have. If somebody has to shotgun your credit to 20 different places to get approved, it's probably because you have issues on your credit report that is the bigger underlying concern.
Yeah, it makes sense. Mark asks, is it better to pay something down to a low utilization rate? Now, just real quick, when he's saying pay something down so there's not a lot of money owed on your credit limit, or is it better to just pay it off completely?
Yeah, let's answer this one quick because here everybody thinks you get your utilization down to 30%, and debt utilization is balances on credit cards divided by your credit limits. And forget what you hear or see on Google about 30%. It's just not the best percentage. Here, if you want to be at 850, you're never going to get there at 30%, right? The best percentage is 1 to 3%. That's the algorithm percentage. We tell our clients 5 to 10%. It's an easy math equation to do for them. That's better than zero, because when you have it at zero, then you're not giving them any clues about how you're managing that credit card. And so you want to keep a small balance on there. And when I say a small balance, that doesn't mean if you have 5 cards, you want to have a 5% balance on every card. I'm referring to the aggregate. If you have 5 credit cards, you should only have a balance on 1 or 2 of them, and then keep that nice and low at 5% or 10%, something like that. But that's better than being at zero.
All right, let me see if I can get Gail's question in here. I have a parent asking what their child can do to create a credit score to buy, which we've kind of talked to, be added. What a parent asking what their child can do. So the child can get added to the parents' credit cards. The parents have told their children if they can pay cash, if they can pay cash, don't buy. Now their child wants to buy a house with no credit. I did suggest the child open up a credit card and a second, buy items and pay the balance off as quickly as possible. So, yeah, I mean, I think, regrettably, that sounds like that individual got not great advice, unfortunately, and we need credit. I mean, you got to have a credit card to rent a car these days. I mean, there's just so many different things that you got to have some credit. So
this is the Dave Ramsey problem. Pay cash for everything. You don't need credit, but you do need credit when it comes down to the big purchases.
Dave Ramsey uses a debit card, but anyway.
Right.
All right. So I think Raven, we kind of addressed that. Catherine asked, is it better to close your credit account or let the credit card company close it for inactivity? It's a good one.
The answer is that from a scoring model purpose, it doesn't matter. It might show as a comment of closed by credit grantor or closed by consumer. Neither one of those has any different impact. Closed is closed as far as scoring goes. But you don't want to ever close a credit card. So you don't want it to just go inactive and let them close it. I have 4 cards that I use once a year at Christmas time. I buy a $20 item and pay it off just so that they don't close the account. So you'd rather always keep cards open. Don't ever close them on your own, and try to avoid them closing it.
Noreen asks, what is the current recovery time after foreclosure or bankruptcy?
Yeah, I actually pulled out my FICO chart for that because it depends on where you're starting before that event happens. If you're at a 680, I'm going to read this for a second here. If you're at a 680 and you have a 30-day late happen, you're going to drop down to about 600 to 620. If you have a foreclosure, you're going to drop from 680 to 575. And if you have a bankruptcy, you're going to drop to 530. If you're a 780, you're going to drop here. The point is that it depends on where you're at on the scale, right? And the higher up the rung you are, the faster you're going to fall down, because they don't know what's going on, why you're not paying your bills all of a sudden. And it's always a prediction. Like a lot of people look at and say, well, what about all this history that I had before? They look at that, but they really are concerned with what you're going to do in the next 2 years. So anything derogatory that recently happens, you fall very fast if you were at a higher score.
So, and one thing I'll comment on, so chapter 7 is pretty standard. Here's the waiting periods, because you guys want to know how quickly can I get them into a house, right? So for a chapter 7, traditional waiting period is going to be 2 years for an FHA loan, 1 year if they have something called extenuating circumstances, which could be anything from a divorce, major medical catastrophe, loss of job. What isn't considered extenuating circumstances is a financial mismanagement. Hey, I got over my head. Sorry, lost the house, filed bankruptcy, whatever it is. Now, on the bankruptcy item, though, Chapter 13 is treated much, much differently. In a Chapter 13, FHA will lend to that borrower while they are in the Chapter 13, providing two things. Number one, they have to make 12 months worth of on-time payments, which is automatic now because the trustee basically does debiting right from the payroll check. So it's pretty hard not to have an on-time payment history. The second thing you need is eventually judge's approval. Now, I added the word eventually because the courts have changed how we get that approval. We used to be able to get it before they went shopping. Now we're actually getting it after they are under contract. It's happened very quickly. We've done 3 loans in the last 2 years where the people were in an active Chapter 13 and did buy a house. All right. There is Katrina asks, are there programs? This is more for me, Jim, by the way. Are there programs for first-time buyers that have actively been working on their credit for a year? And I really think that boils down to, actively working on their credit. It kind of goes to the example we talked about, the couple where we gave the advice to the low score and they manipulated the person with the high score. Actively working, what did they do? Did they make active improvements? Did they follow the advice? I don't ultimately know. Is there a way to get somebody approved for an FHA loan if, they still don't have any good credit? They stopped having bad credit. They're working on getting rid of collections and things of that nature. They're using Jim, but they're paying their rent on time. They're paying their utilities on time. They're paying everything else. I can use that history on an FHA loan, provide and use that to go back to an underwriter and say, yeah, we pay rent, we pay gas, we pay electric, we pay car insurance, we pay our mobile cell phone bill, whatever. If I can get some things that are alternatives, I can definitely get them into an FHA loan as they're working on that.
And the thing they want to do is make sure they're doing the right things when they're working on their, because I've seen people work on their credit for 2 years and get nowhere because they're not necessarily doing what they should be doing as far as their credit. So working, getting some good solid advice is always recommended.
So this one comes up a couple different times. What's the fastest way to remove derogatory items? That's from Robert.
Call me.
Perfect. You know what? We're gonna get through these questions, so I love it.
I mean, that's the short answer because it's more complicated because in order for them to effectively remove something, you have to have an understanding of the Fair Credit Reporting Act. So it's not necessarily a simple answer. The simple answer is work with a credible company that can dispute it properly.
Yeah, and speaking of that, Jim, I want to actually I want you to be able to share with everybody what's going on in Springfield. We have some other questions, guys, but what Jim's about to cover is critical, and it's critical that you get involved. If you're not paying attention or you're checking your phone, please pay attention to what Jim's about to talk about now, because the use of services like his is at jeopardy of going away, and we need your help to tell Springfield, this isn't the best way to handle it. Jim, tell them what they're looking at and what we're dealing with in Springfield right now.
So for the past 2 years, there's legislation that's been introduced that severely impacts the credit repair space. It was defeated last year, but they brought it back, and this is funding by a non-for-profit that's heavily funded by corporations and banks and the credit bureaus, those relationships. They don't want to make it illegal. They want to make it so prohibitive to be able to run a credit repair company that it will basically put all credit repair companies out of business in Illinois. So one of the things that there's a whole bunch of nonsense in the bill that they're proposing. And one of the things is that you have to provide services to a consumer, and then you have to stop the services, wait an additional 6 months after you're done working and ever talking to the consumer. You have to wait 6 months and pull another credit report to show that whatever was deleted is still deleted. And then you can bill the consumer for the first time. You cannot bill them. So if you work for somebody for, let's say, 6 months, that means I have to wait 12 months before I can even bill them, assuming they even pick up the phone. And the other problem is I can't pull legally, we can't pull credit reports anyway. So we have to, nobody's going to wait 6 months after services are done to be able to bill someone. And there's a whole bunch of other nonsense in the bill too. And it's very aggressive. The bottom line is that statistics of complaints by the CFPB in Illinois, there's 74,000 complaints over the last 4 years for the category of credit reporting and credit repair. Those two entities in that category. And everybody thinks that credit repair is the big bad player in that, right? 74,000 complaints, and credit reporting and credit repair are the only two entities in that category. Of the 74,000, only 121 were credit repair. All the other 73,000 and change were all for credit reporting. And they're trying to put us out of business so that they can just run wild with whatever they want to do.
So I would tell you guys, now I just did this on my phone. Unfortunately, it takes me to a place where I can't necessarily do anything on my phone. So we're going to go ahead and get the link emailed out to everybody, and the QR code will go out. So, if you want people to be able to use companies like Jim's, and just so you know, every industry has bad actors. And, credit repair, credit restoration is no different. The biggest, baddest actor got their hands slapped pretty significantly. What was that judgment against them?
Lexington Law got hit with Lexington Law on creditrepair.com, $3.1 billion, and they filed bankruptcy. With a B, and they filed bankruptcy over it. They're reorganizing now, but that was a big one. That was a big one.
The bad actors, the big national companies that are bad actors, they've got slapped pretty hard. The local people that actually do good by people, these are the people that we need. I mean, I don't want a client who has no access to the phone during the day because of their job to not be able to get their credit repaired and get into a house. That's ridiculous. So speaking of which, Nancy had a question. She wanted to know, can you touch on your services and what the cost for your services are? Thanks, Nancy, for asking the question.
Yeah, thank you, Nancy. So the short answer is, first of all, there's no upfront fees. Any company that says pay us now and we get started, that's completely illegal. No customer should ever do that. It happens all the time because consumers don't realize that's actually a legal advance fee. We charge $139 after 14 days, and then $99 month to month after each monthly service is completed. Some people are done in a month or 2 months or 10 months, or depending on what's going on with their credit. It just depends on what their goals are and where their starting point is. But that's the only thing they ever pay is $139 after 14 days, $99 month to month. And we do something different than, I don't know, any other company in the country does this. We actually send every single dispute letter. We email it to the consumer. They see every single letter. Most companies, even if you ask to see the letter, they will never show them to you because they don't want people to know the secrets. But my attitude is, this is not secrets, it's strategy. And so people deserve, how do you even know they're writing letters if they won't show them to you, right? I mean, so we're very, very transparent and honest. And again, my goal is to help you sell more houses, right? Help Rich close more loans, because the better job that we do that for everybody, it all kind of, it's a circle of trust of you. It's a relationship. So
yeah, Jim's been great. We refer no other company and love him to death. We got a bunch of really good questions. I'm going to try to shoot through these real quick.
Yeah.
What about a settling account for less? So in other words, so the Bureau now says, hey, settled for less. Is that bad, Jim?
Okay, so it's a derogatory term. The answer is, it is bad if there's nothing wrong with that account right now. Meaning that if it's an on-time account and you owe 20 grand and you just want to try to settle it. First of all, they're probably not going to be willing to settle it if it's not a derogatory account. But that is the only scenario where it will impact the scores negatively. If it's already a charge-off and you want to settle it, it's already negative. You're swapping out a charge-off negative comment for settle for less than full balance. It's a swap. It doesn't really affect the credit worse.
Here's a good question from Celeste, and I kind of know the answer to that, but I want your spin on that. So on a mortgage report, what about an IRS obligation? That's not on our reports anymore.
No. So judgments and tax liens were deleted off of all 3 credit bureaus I think about 4 years ago now. They just don't appear anymore. Now they will show up on a mortgage report, but that's because a true mortgage report is pulling data also from LexisNexis, so it's bringing in public record information, but it is not on the actual reports for TransUnion, Experian, and Equifax. The good part of that is it's not adversely impacting the scores at all, but it doesn't mean that it doesn't exist.
Yeah, I mean, the bad part is, and we've had this happen because there was legislation put into place that took those things off the bureaus. And there's sometimes, and I'm sure I've got agents in here that have experienced it, we have as well, when our buyers get into closing and title's going, hey, what about that old tax, that state tax lien? LexisNexis missed it, whatever, but the title company didn't miss it. And now they're going, hey, you owe the state of Illinois $584. We know you paid that, right? And most people are like, what are you talking about? So regrettably, the title companies are doing some of those, again, something created to help the consumer sometimes is biting us in the rear end when we get into those closings. Now, Joe Restecca asks, if you close some cards because you have too many rarely used, wouldn't that drop your credit score due to the amount of credit usage would go up? So what he's saying is, and I think we've already addressed this. Yes, closing cards is never good. You want to keep the cards open and have a little bit once a month activity on them. And that way you have the older cards, you have the higher credit limits. Collectively, it's actually a good thing.
And as he mentions, if you close cards, it can increase your debt utilization potentially too. So that's another. The point is, if you have a bunch of them, just leave them open. It is what it is. Just don't close them.
Yeah. Is there one bureau that's more important than the other two when it comes to mortgages? I already know that answer. But
yes, the middle one. Really, they're all three the same. It just depends on what the middle score is, really. And but there's not, there you might want to expand on that a little bit.
Yeah, no, so we're pulling three bureaus no matter what. The middle score is always the one we use. So, and there's no rhyme or reason as far as which the middle one is. There's a middle one. That's your score that's going to be indicative. It's going to drive your interest rate, going to drive your cost for PMI, going to drive underwriting, the whole 9 yards. Seema, Daryl, and Raven asked the same question. How do you improve your credit score quickly, like add 50 points within a few months?
It depends, right? It truly does depends on what's on the credit. First thing to look at is the first two things is look at revolving credit in credit cards. If you don't have a credit card, get one. If you have a high balance or high utilization, pay it down. Those are the two quick answers. But again, if you have 3 cards, that doesn't mean go get a 4th one. That's not what I mean. So and if anybody wanted me to just review a credit report for one of their borrowers or, just send it to me, I'll be more than happy to take a look at it. Here, free advice. If they need our help, they need our help. If it's free advice, my job is again to help you close more sales. So.
Perfect. This question came up from Adeline, Noreen, and Kelly, and it's kind of around the same thing. Mm-hmm. So I'm going to ask 2 questions. Bear with me. Yep. Noreen and Kelly said, how much does an unpaid student loan have on your credit score? And, the follow-up question, which is part of Adeline's question. Thanks, Adeline. What are your thoughts about the impact of medical and student debt? Is there chatter in the state of Illinois to cancel medical debt? I hadn't heard that, by the way.
I've never heard that before. I doubt that would happen. So one thing really quick, as far as medical debt goes, they only report medical collections with a balance of higher than $500. Anything less than $500, if you pay it off or whatever, if it's $490, it will not appear on your credit report anymore. I think that's a great thing for consumers. If it is on the credit report and it's over $500, a collection's a collection, right? It's adversely impacting the scores. And here's the thing, we should absolutely start working on that immediately, because nobody ever went to a collection agency's office for a doctor's visit, right? So there's questions that can be answered there or asked there. As far as student loans debts, the debt itself, the account itself is not adverse. Even if there's a lot of them, it's not necessarily adverse. If it's delinquent, it certainly could be adverse. If it's a collection or a charge off, it's adverse, but just the presence of a debt, even if it's in deferment, is not adverse to the scores at all. The only time that it can start to adversely impact the scores, if it's in deferment for too long and the original balance, the balance starts increasing above 120% of what the original balance was. You keep accumulating interest, then it can start impacting the scores adversely. But other than that, there's no impact adversely.
So $1,000 student loan in deferment, the interest piles up. Now the balance is $1,300. That's going to have a negative impact.
That can start, right, because it's just not in repayment at that point.
You're over 20%. Okay.
Yep.
There's a couple mortgage related things that popped up. Heather Farrell asked, what's the lead time for a loan these days? I'll use Jim's famous words. It depends. So ultimately, I always tell clients, we can move as fast as the wind, as long as the client moves as fast as well. Clients are very responsive. We close loans in 10 days. Now, the depends parts, of course, are, let's talk about VA loans real quick. I don't control the appraisal piece on the VA loans. They have their own appraisers. They move at their pace. That's number one. Number two, renovation loans specifically are definitely going to take a little bit longer than 30 days. Anything else, including IDA loans, we should close in 30 days or less easily. Renovation loans, 203Ks, Fannie Mae renovation, we do VA renovation loans. Those typically are going to be about 45 days out. There's some extra complexities with that. What is our little bit too difficult? Victor asks, what's our process for determining whether or not to approve a loan? That's a whole other class. So
it depends.
Unfortunately, yeah, that's a whole other class. But Victoria asks a really good question. The difference between 1099 and W-2 clients, why do they get different pre-approval amounts from different lenders? Let's talk about the first part. A 1099 employee, a 1099 person is technically not an employee. These folks are self-employed. A W-2 person is an employee. The biggest difference is your 1099 employee is going to have write-offs, number one, and is going to have, he or she will have instability in their income. Their income can go up and down. With a 1099 employee, we need time. We need to average to see what their expenses look like and what their income is, and to see some consistencies. FHA is going to require a 2-year period. Fannie Mae, I can get away with a 1-year period with certain special circumstances. So that's the thing about the 1099. The second part about it being, why do lenders give different pre-approval amounts? Honestly, I think some of that has to do with the skills of the loan officers that you're working with. Some of it has to do with their own internal company policies as far as what they will allow. Chase, for example, might tell their loan officers that we don't do FHA loans under 660 credit score. Well, that's a limitation, right? But FHA goes down to 500. It's just, they're at Chase and they have special guidelines. I don't mean to pick on them, but it was just there. So the fact of the matter is, why those things vary or are different is, number one, it's the skill set of the loan officer that you're working with. Number two, it is what restrictions, or dirty word in our business, overlays that their lender has in place that would limit the type of lending that they would do on those borrowers. So with my team and cross country here, we issue 2 pre-approvals all the time. We issue the pre-approval the client asks for, comes in, says, hey, I want to get pre-approved for $300,000. And then I issue the pre-approval that maxes them out. I don't want them to max out. What I don't want them to do is leave us, meaning you, realtor, and me, lender, because I only gave them a $300,000 pre-approval, even though they were good to 6. They're getting both pre-approvals from us. You're good to 6, spend as you may, or stay at 3 where you want. But either way, those are options for us. Okay, so we got that on the loan side. I think I saw something come through. You're welcome, Michelle. Jim's contacts. If you increase your credit limit. Oh, yeah, here we go. Robert, great question. So I love Robert. If you increase your credit limit, is that better than getting a brand new credit card?
Yeah, that's a good question. And the answer is yes. Because it's a mathematical calculation, right? It's if you increase your limit by $10,000, or you get a $10,000 credit card, the calculation of utilization will be the same, but you don't have the impact of an extra inquiry and a new account being open. So the challenge is you just don't know if you're going to get the credit line increase. But yeah, if everything else being equal, yes, the credit limit increase is better in that scenario.
All right. I told you guys that I was going to handle Ray Kennedy's question that he had all the way in the beginning. We're going to do that. We're going to wrap this up. Most important, guys. Ray asked the question. He would love us in the coming months to do a deep dive in how the NAR settlement plays into financing, appraisals, FHA, VA, and the anticipated changes. Look at your email this weekend. We are going to send you guys a cheat sheet on sellers credits, what's available on every different type of loan relative to sellers credits. This is going to be important if you plan on using sellers credits to pay for your buyer's commissions. Watch your email this weekend. We're going to definitely get that out to you. And we've got a really nice spreadsheet that lays out VA, FHA, all the limitations on the credits. That's number one. Number two, we talked about renovation here. Our next Lunch and Learn is going to be April 17th. It's going to be about renovation. We're going to have Jose Valdivinos here. He'll be talking about VA renovation, FHA renovation, Fannie Mae, Freddie Mac renovation. It's going to be a great session. There's a link right now in the chat for that. After that, we just put this on our schedule on the 23rd. On the 23rd, we're going to be doing a session about how to improve your Google presence and get the green check mark. If you don't know what that is, we'll talk about that too. Jim, I want to thank you for your time. As always, it's awesome to have you here. For me to have you as a resource and honestly a friend is a blessing, and I appreciate you greatly. Guys, thank you.
I'm going to really quick, I'm going to send Tony that if she can send that QR code to everybody, I'm going to get a correction on that. And a quick little teaser, at some point we should do our next one of these with the new scoring models for mortgages that are changing. They haven't changed them in 24 years, and it's some big changes that we should talk about soon.
When's the date of the change, Jim?
It's not getting implemented. They're in the process of implementing it now, but it's probably not going to be until the early part of 2025. But that's going to be here before you know it. And
yeah, we'll talk. Yeah, we'll talk about that for sure.
Yep.
Thank you guys. Thank you guys for participating. We appreciate you. If you have any further questions on this, reach out to Jim, reach out to myself. Cameron and Popovic Law is here for any of your legal questions. Those guys are outstanding. Cameron, thank you again, buddy. We really appreciate it. And
thanks, Rich. Really appreciate it.
Yeah, and none of this happens without Tony. You guys probably know that already. So we do applaud and thanks Tony for keeping everything together, and appreciate her greatly as well. Guys, have a great one. And some of you guys I'll see this afternoon at our charity outing. So take care, guys.
Thank you. Bye-bye.